Hello, I'm Victor Adair and I'm here on behalf of HowStreet.com. We're in Vancouver. It's the second week of June 2009 and my guest right now, Jon Nadler from Kitco.com. They are the world's largest online dealer in precious metals, particularly gold is Jon's expertise, and I want to talk to you a little bit about that. We've seen the price run up almost to $1,000 and seem to run into some resistance. You and I were talking just before we went on air here about the ETF market and some of the real supply and demand fundamentals out there. You're not quite as bullish as some of the gold bugs are. Tell me why.
Well, first of all, their bullishness is based on a number of misconceptions and misperceptions of the current state of affairs around the world economy. Anytime I hear people talking about the imminent Zimbabwe and the Hudson scenario for the United States in terms of inflation, my antennae go up and I say, wait a minute, are you arguing for 231 million% per month inflation in the United States when it's actually fallen into 1% at best, and perhaps it might rise to 3, 4, 5% in a number of years from now after the stimulus takes some kind of toll on the inflation scene? I don't think so. I think we have no reason to expect a baked-in scenario for inflation in this cake, although the Fed's accommodation has been relatively lavish. If you put it into perspective with what they did in 1982, 1983, in percentage terms, first of all, the amount of liquidity injected into the system was far greater back then. And their ability to mop up this excess liquidity subsequent to that and sterilize it and effectively take us under 5% inflation for 26 long years speaks for itself. I think they will be ready to pull the same trigger, raise interest rates, raise taxes if need be. And with someone like Volcker on the advisory panel for the president, I don't think there'll be any reluctance, albeit it's politically dangerous to do so, but the reluctance will not be there to pull this trigger when the need arises.
Let's talk about the gorilla in the room, you call it. That's the ETF market. I'm sure most of the folks watching this are going to understand ETFs, but specifically about gold, you're concerned that a big part of the, call it the open interest in the ETF, is held by the hedge funds who could turn sellers in a hurry if they got a notion. What effect's that going to have in the ETF market and the gold market?
Well, as of yet, it's an unknown. I think what I'm concerned about is the fact that this is a relatively new arrival on the scene, the type of profit-motivated, low-loyalty, short-time horizon type of institutional player who really entered the gold market via the ETF is an unknown to us. I think they're fickle. I think they're certainly not hesitant to pull profit triggers when the computer model says so. And frankly, all we've seen from them is a stage of accumulation for the last 4 years, 5 years almost, which meant that balances were simply increasing and increasing year in, year out, month in, month out, without really any regard to the fact that the market was deteriorating in terms of fundamentals underneath them. Now we have a situation where 10 ETFs control about 1,500 tons of gold globally. The biggest one of which is the GLD, controls 73% of that at about 1,100 tons. So here we have an animal that is larger than the central bank's holdings of China or Japan, and one which is under no restrictions in terms of the tonnage it can sell if redemptions come in, to be desirable, and one that has shown us that due to the makeup of its balances, i.e. largely institutional players, it is not as loyal to gold long term as you would be and I would be.
So we have a vulnerability here, I think I hear you say, if the price of gold started to go down, or for whatever reason, these hedge funds, who are not the typical long-term holder of gold, decide that they want to sell, could be a weight on the market. Something else you shared with me before we began to run the video camera here was that India actually has become an exporter of gold. I mean, these guys were sort of the biggest buyer in the world of
Always
gold.
have been.
What's going on there?
Well, it's part of the fundamental pillars of the gold market, which now I see as being in disarray. One pillar that has really eroded from underneath us is this scrap supply situation. Basically, we used to have a market in which mine supply was, basically flat to slightly growing, perhaps, on occasion declining. We had a situation where scrap was generally fairly consistent in terms of what you could count on. But certainly we had a situation where India was a consistent consumer of gold at the level of about 600 to 800 tons per annum. As prices started to rise and rise significantly and way past 845 and up into the 900s, Indian buyers basically said, stop, we're going to hold back, we're going to wait for prices that we deem are better value. And lo and behold, the first quarter was actually a total shocker because the country turned into a net exporter of gold into the global market. This is something like, if you like a parallel, it's like Saudi Arabia importing sand. It is unheard of, in my book anyway, and it poses a serious challenge to those who see that the market is still in some sort of balance situation. It is certainly not. Scrap supplies quarter one of this year equaled 500 tons, according to GFMS. That's as much scrap as usually used to be coming to market in a full year.
We're talking with Jon Nadler. Jon is the Chief Investment Strategist with Kitco, Kitco.com, the world's largest dealer, online dealer, I should say, with precious metals. Jon, it sounds, obviously, that you're not an enthusiastic buyer of the precious metals here, gold in particular. You're concerned, perhaps, that prices are going to soften. Do you have targets in your mind, or you just like to be the bid and the offer and be the dealer?
Well, I'd like to, for the record, say that, first of all, we're very enthusiastic accumulators of gold at all levels.
Okay.
If you're looking at gold as the life insurance policy, which it is, for your other components of the portfolio, there hardly is such a thing as the wrong time or price to accumulate gold. Your most important objective should be to have that 10% core gold holding set aside. If you're at 8%, you can buy at 2% now. Price is not the issue. Price performance is not the issue. In fact, we're advocating that you accumulate your gold, set it and forget it, and actually hope that it's the one asset in your basket that doesn't perform. Obviously, because we feel that if it does perform, and certainly to the perma and mega bull levels that are being bandied about, then the rest of your assets have just gone up in smoke, and that's probably not a desirable scenario for anyone. So we're always gold advocates for long-term holding at a threshold of about 10%.
We've been talking with Jon Nadler, Kitco.com, Kitco. Go there when you need information about the gold market. You can read Jon's comments there twice daily. Jon, I want to thank you for being here. This is Victor Adair on behalf of HowStreet.com. Thank you very much for watching.
Comments made on How Street Video and HowStreet.com are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at HowStreet.com. How Street Video is a production of How Street Media Incorporated.